Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I've been wanting to get her on for a while, and finally, we've gotten her on. She's definitely a real estate expert. She has her own radio show, and she's the CEO and co-founder of the Real Wealth Network. Her name is Kathy Fettke, and she's definitely someone that you should pay attention to if you want to learn about real estate. So thank you for joining us here today, Kathy.
Thank you.
Kathy, I want to start off this interview talking about your background and how did you get into real estate? What made you decide to get in the real estate market?
Well, it was actually watching my parents make a lot of money in it by accident that first got my attention because I grew up in the San Francisco Bay Area and my dad bought a house for about $90,000 in Menlo Park. And about 15 years later, that house was worth $1 million. Then he sold it, and he was quite happy with his earnings until he found out 5 years later it was worth about $2 million. But that's not a normal market. That's just California.
Yeah, that sounds like also the Fed has been pushing up, and that was around the time when you had the Silicon Valley, the technology just explosion, right? Because San Francisco's economy changed drastically with the technology, right?
Absolutely. I mean, I grew up right in the Silicon Valley and just down the street from Steve Jobs, and it was all right there. But I saw my parents just by accident make the most of their money from just buying a house and living in it and staying in it over time, and in this case, in a well-positioned place. And the other investments that my dad did that he actually researched and tried to make money on. Usually those are the ones that failed, but it was the real estate that has really carried my mother through her senior years. Now that my dad has passed on, it is the real estate that's sustaining her. So that was the first that got my attention. But then the way that I got into it also was a bit by accident, where my dad needed to do a 1031 exchange from an apartment that he'd been in, and for those of you not interested, an exchange is a way that you can sell property and not have to pay the capital gain, or I should say, to postpone the payment of the capital gain, because you can exchange into another property. And so, but you only get 45 days to identify that property, and my dad was already at day 20, so he was kind of under the gun and said, he called and he was a little desperate, and I didn't own a home yet. This was back in 96. And so I said, well, listen, Dad, I'll find you a property. How about I be your tenant and I get to inherit the property someday? So that's how I got in my first deal.
That's a very interesting story. So after you found out about your parents making money in real estate, what did you do to get into the next level of trying to learn about the real estate, the in and out? Is there any book or courses that you took or read that helped you?
Oh yeah, absolutely. Because with that first property that I got from my dad, it was a huge 4,000 square foot 6-bedroom house, and it was to my husband just way over our heads. But I looked at it and said, well, we can rent out the in-law suite, we can rent out the office that has its own separate bathroom and separate entrance as a studio, and if we rent those 2 units, we actually get the remaining 3,000 square feet to ourselves, and we're paying less than we would have in rent. So we became landlords kind of right away, and that all made sense. That property ended up making about $100,000 a year because, again, it was we just lucked out. All of this beginning stuff was just luck. Bought in 97, right before, that was right at the end of the last downturn, and so we got to ride that one up for about 10 years. But then right about then, my husband was diagnosed with melanoma, and he was told, he was misdiagnosed and told that he had 6 months to live. So the good news is that the doctor was wrong and my husband is fine, but at the time I didn't know that, and I had to figure out how to make money. In spite of all the, just the horrible news, I had to figure out how to make money. So I used my show, the Real Wealth Show, to do this, just to interview people and find out how they make money. How did they make wealth? How did they get to a point where they could not worry about things like medical bills and these surprises that come up? And it always, in many cases, came back to hard assets. It came back to assets that bring you cash flow and appreciation. And I just really, the way I learned was interviewing experts on my radio show and reading their books.
Very good. And so some of those books, are they like the Rich Dad Poor Dad Robert Kiyosaki books or something, or those, or are they other more detailed stuff from other experts?
I read everything, but yes, Rich Dad Poor Dad was definitely a soul shifter in the sense of it just changed my belief of what I could create. But it didn't give me the specific tools I needed to do it. It was just more of a,
Changing your mindset, like to an entrepreneur, an investor. And yeah, I would agree with you on that, because his books tend to not be, very heavily detail oriented, but they tend to move your mind towards, the right side of the cash flow quadrant, where you're thinking about how to be an investor, how to be a business owner, and things like that. So I definitely have enjoyed his books, and I've read a lot of his books on investing, but I'm interviewing you because I don't know the details of real estate investing, because, even with all of the Robert Kiyosaki books I read, I just still don't feel like I've learned enough details to be comfortable to deploy capital into the sector.
And that's wise, because too many people jump in without having any idea how to do it. And, I feel guilty about that. Oftentimes I'll do a radio show and get everybody pumped up because I am so excited about real estate as an investment. And I forget to mention sometimes that, wait, you've got to understand it before you do it. In many cases, it is the largest financial decision you'll ever make. And yet people have taken it so lightly, just signing documents, signing up for loans they don't understand, buying property they don't really know what to do with.
It never really stocks too.
Oh
thing.
Yeah, I'm
it's
sure.
Just
Yeah.
Here's an interesting fact, and this applies to the real estate market too, a stock market. Most Americans, and I don't know if this applies to foreigners, but most Americans spend more time researching, what refrigerator they want to buy, or computer, or where they want to go on vacation, and, travel deals, than the investments that they're going to make, and which one's more important. So, if you make really good investments, right, you can afford to overpay for vacations and things like that in the long run.
Yeah, absolutely. It's amazing to me how quickly people will throw their money, and I do think that comes back to mindset. Oftentimes people don't feel comfortable with money, and sometimes they just want to get it out of their bank account. I know that sounds crazy, but I've seen it just too often where, like you said, there's not enough attention to where is this money going, and is it going to make me more money?
Well, they're not paying the attention, Kathy, probably because the Fed has set the rates near zero.
Yeah, that's right.
Yeah, it's forcing people out the risk curve there, and people don't know what to do because, normally in the past, people who had just put money in the bank could get 5% or 10%, according to, historical average interest rates and things like this. But I want to transition now. Let's talk about your general views of the real estate market here. We had the crash, obviously, in 2007, 2008. Have we had a real recovery in the real estate market? Is there a lot of first-time home buyers, or is this recovery that we're having right now, is it mostly generated, you think, by the central banks like the Federal Reserve just giving hedge funds free money to, buy up entire streets of properties with?
Everything is so manipulated. It is really hard to know where we are and what the free market really can bear. And with that said, we live in a manipulated market. We do not live in a free market anymore. So we have to learn how to make money and survive in a manipulated market. So yes, we are. We're in a situation where you just have to come back always to what are the fundamentals and how will this work for me no matter what's going on. And so to answer your question, there are bubbles popping up all around the country because of these low interest rates and because there's international investors and hedge funds buying up real estate by the billions. You add on to that lending is getting, the FHA loans are the new subprime. So you can just be a couple years out of foreclosure to get back into real estate. And there's tremendous demand. So with all of that, I can tell you in the San Francisco Bay Area and in Los Angeles and most of the high-priced markets and the desirable kind of tier one markets, we're pretty much at 2006 peak prices. We're back.
Wow.
Yeah.
Do you consider Washington D.C. is that considered a tier one?
Yeah. I mean, your pricing is going to be a little more affordable than, say, California, or I mean, again, depending on which neighborhoods and all. It's not going to be New York prices or San Francisco, but yeah, absolutely. I mean, Washington has had a lot of job creation, right?
Yes, unfortunately, yes. A lot of lobbyist job. The lobbyists are doing fabulously well here on K Street. Their bonuses are enormous. Government bureaucracy is doing very well here with all
Yeah.
Obamacare and all these other things. But yeah, I just wanted to share some of these stories with you. I'm friends with a good amount of real estate agents here in the DC metro area, and they've been telling me the market's just on fire here. That there's a humongous amount of foreigners, humongous amount of very high net worth people moving here. Either for government jobs, high-paying government jobs, or other things. And there's a lot of stories of houses being sold that they hit the market, and 2 days later there's already 6 bids. There's bidding wars, all cash offers. People are willing to pay, $50,000 or more over the asking price to get the deal done as soon as possible. And also, Chinese investors paying all cash and then hopping on a plane the next day and going back to China. So
Yeah.
I was wondering.
Yeah, that sounds like our market. Yep.
So, if the real estate market was healthier, right? Well, let's talk about if the market was healthier. If the market was healthier, there would be people in Mo's demographic and my demographic, right? We would have nice, higher-paying jobs. So we'd have like $50,000 to $70,000 jobs after our graduate school or a couple of years of work experience. We'd have savings in the bank, and then we would be able to afford starter home and things like that. And we'd have a wife and kids and things like that. But that's not what we're seeing in the statistics, right?
Yeah, the millennials it's really a mixed bunch. These are basically the kids of the baby boomers. It's a huge generation. I just saw the numbers recently, but I don't have it in front of me. But it's larger than the baby boomer generation, and so there's challenges for that generation. And that is they just kind of watch their parents lose a lot of money. They're not really excited about real estate necessarily. And they're probably not going to be in a big hurry to buy. They're probably going to be renters for a little while. So I don't really see that that huge demographic hitting the housing market until I would say about 5 to 10 years from now. So that will be an issue. And so, but I do believe there'll be another recession before that. But so anyway, if you look at real estate for the long term and and say, all right, here are the main things we need to look at. Number one, job growth. If you're going to buy real estate, it needs to be near jobs and not jobs that are here today, gone tomorrow. So these are, and that's really difficult to gauge because our marketplace is changing rapidly. And so I look at these San Jose millionaires who are in the Silicon Valley today, and they're paying, just like you said, they're paying $1 million for a tear down, and they're taking it as is, and no questions asked, and they're just betting on the fact that the Silicon Valley will always be, but will it? And
not if San Francisco raises the property taxes much higher, right? So
well, that and you just have to look at where are these jobs going. They are not all staying in the Silicon Valley. They are going to places that have affordability. So we see a lot of internet companies moving to, and high-tech companies moving to Austin. We see them going to the Carolinas. Kind of just all over the country, really, in affordable states. We see them going to the Pittsburgh area, Cleveland. I know Google just moved one of their headquarters to Pittsburgh. The same with LA. We've got Hollywood studios moving to Pittsburgh, if you can believe that. It's the second largest film industry in the country next to Hollywood, in Pittsburgh, Pennsylvania.
Wow, did not know that. But
Yeah.
Pittsburgh had an experience, though. They had, the steel industry, a long time success, and they had very high taxes, just like Detroit. Pittsburgh's actually Detroit, I would say, advanced. If Detroit recovers, they'll hopefully turn into Pittsburgh. Because Pittsburgh, had too much socialism, too many social programs. The taxes were too high. They drove the businesses out. They were stuck with the bill. They had, they reorganized their they reorganized their payments and their taxes and things like that. And now Pittsburgh has a more diversified economy with lower taxes. So hopefully Detroit and some of these other cities and Chicago are going to learn from, the mistakes that Pittsburgh made and adapt that way. But unfortunately, I'm not as optimistic on politicians as I am on investors and entrepreneurs like yourself.
Yeah, as it should be. As it should be. Again, if we could just go back to a free market, then we wouldn't have such a difficult time guessing what's going on. But even so, like I said, even with a manipulated market, so you look at Pittsburgh, like we just said, we've seen some major changes happening to that state, and yet you can still buy properties for $30,000 to $40,000. And granted, they need fix up, and they're going to need maybe $10,000-15,000, but still, you can get into a single family home in a market that's really turning itself around for $50,000. If you don't have $50,000 and you need to finance it, that's a $10,000 down payment.
Well, that's affordable, and most people have that money in their 401k or IRAs, and they're probably not getting that type of cash flow that you can get on a rental property in the form of dividend stocks, right? So
that's right. I mean, if you let's say this is what I do, and I help people do all the time, is find little homes, little affordable homes in areas where there is job creation happening, where the cities are revitalizing themselves. Like you said, a place like Pittsburgh that completely turned itself around. We started this with Dallas, Texas. Dallas got hit so hard in the 80s because they were dependent on oil. And when we went through the 80s recession and the banks got hammered, then they had a major recession in Texas. But the leaders there figured it out and turned it around and made it a job-friendly place. That has created the results of having the most headquarters in one place in Dallas, Texas, because they've been such a job-friendly environment ever since that. And of course, now we've seen that home prices went up significantly with the jobs. Now we're not even buying in Dallas anymore because it's becoming a little too expensive for us.
Yeah, and that would make a lot of sense because, like you said, you mentioned that the job growth is the most important, so wage growth and job growth. So if you're California, right, and you've had all these amazing businesses there, California used to have, by far, the most successful and diverse economy in the United States really through the 1980s or 90s, and then the taxes just went nuts, and you've seen so many factories and not just the movie industry, but all these other industries leave for Texas and Nevada and things like that. And obviously then the property values in California, they're not going to stay as high, at least not for, well, maybe in Malibu they will, right? But
yeah.
but not like in some of these some of the suburbs there, an hour away from LA or 2 hours away from San Francisco or things like that, because people don't have the jobs there to justify paying those property prices. Although, if China's going to print up a lot more money than even the Federal Reserve, maybe the Chinese are just going to come in with, suitcases of money and buy up all those properties.
Well, they are. I mean, it's unbelievable. California is a unique place because it's beautiful and it's warm and it's desirable. But it doesn't have the kind of cash flow that I would look for, and it's not a landlord-friendly place. So part of what I do, I mean, the main thing I do is help Californians and Australians and other people who are in high-priced marketplaces who just can't make the numbers work in real estate. I help them find other areas of the country where it does make sense. And a couple of the rules, like I said, number 1, job growth, number 2, population growth, they go together. Number 3, affordability, and when those 3 things are together, we get excited and we want to look further into those markets. I want to see at least 1% of purchase price in the rent. So if I were to buy a $100,000 property, I would want at least $1,000 in rent.
So you're talking about price to rent ratio there. Is that correct?
Yes, that would be the price rent. Where in California, you're not going to come close to that. You get maybe 0.5. You don't get about a half of that. So you wouldn't even find a $100,000 property for one. But if you did, it would probably rent for about $500 a month or $250 a month. You see, whereas you go to somewhere else in the country and you can get that 1% ratio. I'm actually still finding 2% in some areas where I can buy a property for $60,000 and rent it for about $1,100 or $1,200 a month.
And those are not Section 8 houses. Those are middle class, like in nicer neighborhoods?
Yeah, I really like that. For me, the sweet spot is the middle class. The A properties, the really nice areas, they're just too expensive and they don't cash flow. They might be good for appreciation, and so institutional investors like those. A lot of the hedge funds were buying up those A properties because they weren't so concerned about the cash flow. They were happy with a 3, 4, or 5% cash flow. But I like the middle class, where you've got good working class people who, this would be the teachers of the world and the nurses and the firefighters and so forth. This middle class neighborhoods where people have good jobs and they want, they're raising their families. They want good schools, and there'll always be a demand for those neighborhoods if you need to sell.
What do you think about the Charlotte, Raleigh, North Carolina area? Because we're seeing a lot of population growth in that area. Do you think that area fits in your criteria?
We really have always, we've liked Charlotte and that, that whole triangle area over there, that has been on our radar, and we liked it especially a few years ago. But we've seen the prices go up there as well, so we're having a hard time. We're having a hard time finding numbers that we like.
Are the prices going up across the board in most of the markets that you look at, or are there some exceptions?
Prices are going up, and it's partly like we talked about the manipulation of these low interest rates. But also the biggest reason that there's still some pockets of the U.S. where you can get good deals is the judicial system. So some states have laws where you can't foreclose the way you can with a trust deed, in trust deed states. You have to go through a court system, and you need a judge to release the foreclosure. And those states, those judicial states, have a huge backlog of foreclosures still. So because they have more inventory and more distressed inventory, prices haven't gone up yet, but they will.
I think we see a lot of that in Florida. Is that correct? I think
Yes.
Florida, you have to go through the court system. Yeah.
Yes, Florida's a judicial state, and it is on our radar right now as a hot place to buy because, prices are still depressed. But once that distressed inventory is sold, you're going to see a huge bounce back in prices there. So yes, Florida is on our list. We have some really good teams and property providers and renovation teams up there, property managers. Yeah.
Now, do you also monitor property taxes? So if property taxes start to rapidly go up, like let's say every year they go up 10%, because some of our listeners, we get emails and we get messages in from our listeners. We get a lot of thousands of views on these podcasts, and some of them are moving, out of New York, out of Connecticut. They're moving out of Maryland. Their property taxes are going up, 8, 10% every single year. Their wages aren't going up that much, and they want to leave and, go somewhere else, or maybe they want to rent out that home to someone else if they can't sell it on the market. Is that what we can expect to see in the whole country, or do you just think it's a certain number of states maybe that are more heavily controlled by more tax-hungry politicians?
I don't know when, these politicians are ever going to figure it out that when you tax people to death, there's no money left to stimulate the economy, and there's no money left for a free market. It's a problem. Now, Texas has proven somehow that even with high property taxes, people are okay and the economy's thriving. But I think that's probably because there's, so many jobs and because home prices are so low. So if you have 3% property tax on a $200,000 home, it's still not that bad, but really taxes are going to kill our economy and the middle class and small business. And goodness, if we cannot
we're frustrated
people,
too. We talk about inflation and taxes way more than we like. Trust us.
It is no fun. It is no fun to write those big checks and have no control over who's spending it where and what. But Let's talk about real estate because I don't want to talk about taxes.
Okay.
But you're right.
Okay, so if our listeners then, if they're doing well with their physical holdings, they have some resource stocks, they have some oil cash flow stocks, and they want to also, go into the other hard asset, into real estate. What type of money then are they looking at? Did you say it's $10,000 down, or are they going to be they going to need $50,000 to buy their first rental property?
It just depends on the market and who's willing to lend. Most lenders don't like doing small loans like that, but there are some that will. So, it would be possible to buy a $50,000 property, put $10,000 down, and now you have a $40,000 loan. Like I said, there's not a lot of banks that'll do that, but there's some. And so when you look at, a $40,000 loan on a property, that's less than a lot of cars out there, right? And take your car payment and spread it over 30 years. It's going to be pretty small. That's what these feel like. These are little $200-$300 loans. And the rents are going to be closer to $800 on something like that. So that's how you make the money. You've got the cash flow that you can put towards paying off that loan. I've been trying to teach people that if you can lock in today's low interest rates, if you can take advantage of your fantastic credit, if you've got good credit, if you've got a 2-year job history, and you've got some reserves, and you can take advantage of today's low interest rates, you can become very, very wealthy. One of the ways that you would do that, and most people don't know this, is you can get up to 10 loans. Banks, if you're a good borrower, and when I say a good borrower, it's like, can you qualify for a $200 payment? Probably. And so if you were to basically be in a position to buy 10 of these little homes, get 10 loans, buy 10 of these little homes, you could take all of the cash flow from all 10 of those properties and pay off one of those houses, one loan on one of those houses in about 2.5 years. And then if you did it again and paid off the next loan and then the next loan, the next loan, you could have all 10 homes paid off in less than 12 years and now have a portfolio of 10 homes paid off, each bringing in over $800 a month. That's a pretty good deal.
That also sounds like Monopoly in real life,
it
Kathy.
Does.
Where I buy all
fun.
those little green homes, and then, I trade them in for the red hotel, like a 1031 tax exchange, like you said. But you talked about paying off debt. But, obviously some people are not going to be comfortable with that. But if I'm a more sophisticated real estate investor, wouldn't I want to only have a certain amount of money down in terms of collateral and stuff like that, and just do what I listen to Jason Hartman's podcast, if you're familiar with him. So, what he calls inflation-induced debt destruction, because obviously the Fed and the Keynesians and the other, people who are trying to manage the economy and anti-free market people, basically, they hate capitalism and business, they want inflation. So any way they can, whether it's, manipulating wages higher, prices higher, whatever. And what do you think then? Is that so? Real estate's probably then the best strategy then to take advantage, or one of the best strategies to take advantage of, if you're going to be able to borrow at such a low interest rate, like you said, and lock it in.
Yeah, absolutely. If you're young and you sound like you might be, and some of your listeners.
I'm 31, so I'm...
Okay, you're young. So you would do exactly that. You would keep your debt, and take all of that cash flow and continue to use it to buy assets. You would be in the accumulation phase, building a portfolio, buying, building this empire. You don't necessarily need the cash flow now because you're young and you can work, but you'd be building for your future. A lot of our clients really are scared because they're not 30, they're 50, they're 60, and they don't have anything to show for it because they lost, so many people lost their wealth in the last recession. So, it's those people that I would say, use your good credit, get 10 loans, pay them off so that if you're 50, by the time you're 65, those homes could be paid off and you could be living off that cash flow. But yes, for someone like you or like my daughters who I'm trying to teach this to, the young people of the world, absolutely. You're in the acquisition phase, and you should just be using every little penny you have to keep acquiring your assets.
And that's very good advice, because a lot of people out there are trying to go big in the real estate market and end up losing a lot. So it's always good to start small so
Yeah.
you can learn the business in and out, and then go from there.
Yeah, I've read I don't know if you pay attention to this, Kathy, but I've read too many stories of professional football players doing like $60 million real estate deals with their own capital, and they have no idea what they're doing, but they're trusting, trusted advisors, and it's a highly leveraged deal, and then they end up, bankrupt. So, and I was thinking, well, why didn't they just buy a couple rental properties first and learn the business and stuff like that? But no, they already have a lot of money, but they want to make even more, and they don't want to learn, and they don't want to do the due diligence and start off small, like you're telling our listeners they should do and stuff like that.
Yeah, it's really sad. I have a friend who actually sold her condo in LA to a professional athlete. He bought 4 of the condos. They were about $600,000 each. He paid cash. And he did not stop to read the inspection report that building in Marina del Rey is sinking.
So was the building going to get condemned, or is he looking at hundreds of thousands of dollars in construction costs or something like that?
I don't know what they're going to do. This is a high rise in Marina del Rey that is sinking.
Man.
So I agree with you. People, that's why we started the Real Wealth Investor Academy. It's our ongoing online educational program. We do like 20-minute little videos on everything from tax benefits. I interview CPAs and attorneys, and I make sure they're interesting. Nobody's allowed to be boring. And it's only $97 a month, so just learn the basics. Just please learn the basics.
And that's very good advice. Well, Kathy, thank you for your time. If people want to find out more about what you do and where they can find your radio show, where can they go?
Real Wealth Network is our website, Real Wealth Network, and Real Wealth Show is the show.
Okay, great. Well, Kathy, thank you for your time, and hopefully you can come back again.
All right, thank you so much.